Hello and welcome to Business 360. I'm Shireen Bhan. The headlines we're tracking for you this evening.
Both SBI and LIC have issued detailed statements. They have very clearly said that their exposure is very well within the permitted limits.
In her first reaction on the Adani Group stock rout, Finance Minister Nirmala Sitharaman says that SBI and LIC exposure remains within permissible limits, asserts that India remains a well-regulated financial market and that regulators have kept the stock markets in prime condition. That's a Network 18 exclusive. Adani Group stocks see some wild swings in trade. Some group stocks end in the green after getting battered for the last 6 sessions. Sources say LIC has not sold any shares yet. They will get on a call with the Adani top management to understand their strategy. Global rating agency Moody's says the Adani stock rout can hurt the group's ability to raise capital. Fitch does not see any immediate impact on its ratings. S&P Dow Jones removes Adani Enterprises from its sustainability indices, citing allegations made in the Hindenburg report. Parliamentary proceedings disrupted for the second day in a row as opposition parties demand an urgent probe into the Adani crisis. That's been turned down by the Lok Sabha Speaker and the Rajya Sabha Chairman. Opposition leaders could stage a sit-in protest inside Parliament premises on Monday. A volatile session on Dalal Street ends with the Sensex gaining over 2%. Adani Enterprises, the top loser, down over 42% this week. SBI beats the street in the third quarter. Net interest income comes in at over 38,000 crore rupees. Asset quality improves. Well, that is the big number. State Bank of India announcing its Q3 earnings. The management addresses the media. Let's listen in.
Account for a significant portion of the global growth 2023. Several high-frequency activity indicators like vehicle sales, petroleum consumption, railway passenger traffic, air traffic, RTO revenue collections, fertilizer sales have all shown improved YOY momentum in Q3 of financial year 23. GST revenue also continued to remain robust with 15% higher revenues in Q3 of financial year 23 compared to the same period last year. In financial year 23, credit growth has continued to grow in double digits. The incremental 9-month credit growth has doubled in financial year 23 compared to financial year 22. Credit growth in the system is currently at about 15% as against 9% in last year. The good thing is that credit growth is broad-based and not limited to a few industries or sector. So we expect the pace to continue in the next financial year also, but some moderation may happen. At State Bank of India, we have always maintained that our long-term strategy is to build sufficient resilience in our balance sheet. So while we continue to pursue growth in core operating incomes, we have also been proactive in identifying any potential risk and build adequate provisions for the same. And our operating results for the quarter are aligned with our long-term strategy. I'm pleased to announce that for the second quarter in running, we have again posted our highest ever quarterly profit at rupees 14,205 crores. Our business growth numbers are strong, and in terms of asset quality, our gross NPA numbers have dropped to its lowest level in more than 6 years. Let me now give some color to bank's numbers for the quarter. Net profit for the quarter increased by more than 68% YOY to 14,205 crores, while operating profit at rupees 25,219 crores increased by 36%. ROA of the bank for the 9 months period improved by 23 basis points on YOY basis to 0.87%, and ROE improved by 458 basis points on a YOY basis to 18.59%. Most other core profitability metrics have also improved over previous year as well as sequentially. Net interest income increased by 24.05% YOY on the back of improvement in yields and continuing credit offtake. Domestic NIM also improved by 29 basis points YOY and 14 basis points sequentially. Non-interest income grew by 32.22% YOY. Operating expenses increased by 16.69% YOY as we have started building provisions for the wage revision, which has fallen due from November 2022. Other than that, our overhead expenses as well as staff costs are within control, and our cost to asset continues to remain among the lowest in the industry, reflecting our efforts to build long-term cost efficiencies. On the business front, the growth momentum in domestic credit offtake has continued in this quarter also, with growth coming from all the segments. Domestic advances grew by 16.91% YOY, headlined by retail personal advances, which grew by 18%, which grew by 18%. SME and agri advances also posted the double-digit growth at 11.52% and 14.16%. Our personal retail loan book, excluding housing segment, has crossed the milestone of 5 trillion. Domestic deposits grew by almost 8.86% YOY, driven by growth in savings bank and term deposit. Our foreign offices have continued to perform well with good growth in advances as well as deposits. As far as the asset quality is concerned, we continue to post improving outcomes. Our gross NPA has dropped below 1 lakh crore and stands at rupees 98,347 crore. In terms of the ratio, our GNPA ratio has come down by 136 basis points YOY and stands at 3.14%. Our net NPA ratio has also declined by 57 basis points and stands at 0.77%. Slippage ratio for the quarter stands at 0.41%. The consistently improving asset quality is also reflected in our credit cost, which is at 21 basis points for the quarter and is down by 28 basis points YOY. On the restructuring front, our total exposure under COVID Resolution Plan 1 and 2 stands at 26,035 crores as at the end of Q3 of financial year 23. The restructuring book has behaved well, with almost about 10% of the exposure falling under SMA 1 and SMA 2 category. We are holding sufficient additional provision against the restructured account. As you might recall, we are holding almost about 30% provision, but we are quite hopeful that the kind of NPAs which we have seen in this book, which is somewhere around 2%, we should be in a position to ensure that we don't have any challenge coming from this book. The bank remains very well capitalized, and we expect that our internal accruals will be adequate to take care of the normal business growth requirements. Our capital adequacy ratio, without adding the profit for the 9 months, at 13.27% and CET ratio at 9.26%, are well above the regulatory requirement. Digital continues to be an important acquisition engine for the bank across assets as well as liability products. During the quarter, we have sourced 64% of our savings accounts and 41% of the retail asset accounts digitally through YONO. Our subsidiaries have also consistently performed well and continued to create significant value for all the stakeholders and, most importantly, for the customers. Most of our subsidiaries are leaders in their respective segments. We will continue to nurture these subsidiaries and see them creating value for their own shareholders as well as the shareholders of SBI. Now, before I conclude, I thank you all for your continuous support to the bank. We consider it a privilege to be able to contribute towards the growth of our economy. We remain committed to reward your trust in us with superior sustained returns over the long term. I wish everyone here good health and a happy weekend. The floor is now open for your questions. Thank you.
Thank you so much, sir. Now we'd like to move to the media Q&A. I request the media to raise their hands and unmute themselves when called upon. As always, given the time constraint, we request you to follow the format of asking 2 questions each related to the results. The first question is from Ankur Mishra of ET Now. Ankur, please go ahead. Ankur, can you hear us?
Um, Hello. Am I audible now?
Yeah, please go ahead.
Yes. Hi, sir. So my question is regarding the credit growth. Now, 2 quarters in a row, you have clocked in a decent growth. Last time you said that there is some scope for revision in the credit growth target for the financial year. I mean, that currently is. So do you think that, what is your credit growth target till March end?
I think last quarter also I had indicated that we expect that the growth will be somewhere between 14 to 16%, and I maintain that kind of a number. We expect to grow about 14 to 16%.
Okay. Also, how should one read into the provisions coming down, especially loan loss provisions, which is again less than the what market expectation was?
Well, of course, part of it is attributed to, we are not left out with much of stock as far as the stressed loans are concerned. As you would have observed, our NPA has come down to less than 100,000 crore, 1 trillion. It is now at about 98,000 crore. So that is one of the reasons why we are not required to make as much of provision. And it is also attributed to the better underwriting practices which we have adopted, which ensures that we should be in a position to keep adequate control on any of the stress which might be seen. And as a prudent practice, as and when we get to see some stress, we rather provide for it upfront as against waiting for the event to occur. So I would say that part of it is also our own our strong underwriting practices, and part of it comes from the ecosystem as well.
Last question will be there on CASA ratio, which is on decline. What has been the reason for that? And overall, the deposits growth compared to credit growth is a little muted. So what is your comment on that?
Yeah, deposit growth, I think in the system as a whole, we have seen for the banking system, we have seen lower growth. So I think it is essentially in line with what is happening in the industry. Of course, when it comes to savings bank deposit, in terms of number of accounts which are opening, they are pretty large in number. And I expect that with some kind of a liquidity easing in the system, perhaps we'll have a situation where this growth will also grow up, it will go up. And as of now, we are comfortably placed to ensure that we should be in a position to support the balance sheet growth as far as the loan book is concerned.
Thank you so much, Ankur. So the next question is from Ritu Singh of CNBC TV 18. Ritu, please go ahead.
Mr. Khara, first, you've given us your guidance on credit, growth, but what about asset quality? We've seen that improvement quarter on quarter for the last few quarters. Now your net NPAs also are at less than 1%. What could you tell us now that we're closing the financial year in this quarter? What would the asset quality look like? That's the first question. Where the slippages also came from. I know they've come down to about 3,000 odd crores in this quarter. And secondly, since you're the largest lender to Adani Group, while we read your statements that, the exposure is within the large exposure framework limits, could you tell us more about what the absolute quantum is? If there's any sort of concern there, if you've increased provisions or will look to increase provisions because of what's been happening, with the stocks in the last few days?
Two questions which you have asked. I will answer the first question in terms of how the asset book look like. I expect our effort and endeavor would be to keep the credit cost as low as possible. And the kind of trend which you have seen for the past 2 quarters, our endeavor would be to keep the credit costs around the same levels. But also, I think I'm a bit bullish in terms of how the economy looks like. So that is one of the reasons why perhaps in the near term, in this quarter, perhaps we should be in a position to see that kind of a credit cost. And the quality of assets, I don't envisage any challenge in the quality of assets. Your second question in terms of exposure to Adani, we have lent to Adani for projects which are in fact having tangible assets and which are having adequate cash generation, and they have been in a position to meet their obligations. And as far as the quantum is concerned, that is actually just about 0.8, 0.9% of our total loan book. So from that point of view, we don't envisage any kind of a challenge in terms of their ability to service the loan obligations which they have taken. So, and also we have not extended any loan against shares, etc. There is no such portfolio which we have. So the impact of the stock market prices of the stocks will not really impact any of the margin calls, etc., and any of the loans which they have raised from us. As I mentioned, that it is all against sets which are cash generating and which are having excellent track record in terms of the repayment in the past.
So if you could actually elaborate, 0.9% of SBI's loan book is the total quantum of your exposure to Adani. If you could give us the absolute figures in terms of what is the fund-based and non-fund-based exposure in total to Adani.
It is everything put together.
So if you could give us the breakup.
I think non-fund based exposure, I would only like to mention that they are essentially letter of credit and the bank guarantees, and these bank guarantees are the performance bank guarantees. And this is not against any of the equity raising or any such activity. We actually breakup wise, maybe Swami, would you like to add something? If at all you have, or maybe you can.
Debt from us, and including a small investment of about 285 crores. So in all, the exposure total is about 0.88% as on 31st December. And as you clarified, sir, there is nothing which is against acquisition or against shares in this. If you require any other granular data point that we can share offline with you.
In fact, we have not issued any guarantee towards securing any of the financial obligations or acquisitions either. So as I mentioned, that these are all performance guarantees or the financial guarantees, but done and which are required in the normal course of business. And there is nothing which we have done which can cause a concern for us.
Thank you, Ritu. So the next question is from Mr. Abhijit Lele of the Business Standard. Abhijit, please go ahead.
Good evening, sir. Staying on the Adani, what we are discussing or what you're giving is the situation as of now. But they have a huge pipeline of projects that have been sanctioned. The credit is there. So when you are actually releasing the money for the sanctioned credit, are you increasing your information requirement or doing more due diligence? Is there any shift to safeguard future interest? What you have spoken is still now what is it is.
When it comes to project which have been sanctioned, there is a requirement for bringing equity upfront, and that is something which will be always insisted upon. And unless and until equity is seen, the debt amount is not released. So that is something how the project financing goes. So I think on that particular count also, as of now, the kind of projects which have been where we have granted the facilities, they are the one where already the equity is already seen. It is not that we are waiting for some equity. So, but as far as going forward, each of the project, each of the of such proposal will be evaluated on its own merit. So, and also it is a discussion which is vested with the credit committees and also the sanctioning authorities. So everybody will be very mindful about what the situations are, and accordingly decisions are taken.
Have you also done any kind of have they started any interaction to give you some kind of confidence? What you have spoken is about your exposures and all, but there is much more to it than just the balance sheet. There is much more in terms of what events are happening, what events might happen to them. So have they begun any conversation to give you the confidence?
No, as of now, it's a normal course of things which we are doing, but any special engagement we have not yet started. If need be, we will engage with them. But as of now, as I mentioned, that lending which we have done, it is against the projects which are having adequate cash generation. So for us, for the time being, there is no concern.
Okay, and the last one is about the deposits. What is the guidance that you are giving? Because 8.8 or something is slightly even lower than the industry level. So in the coming this quarter, assuming that you might increase your pace of fundraising. So what would be the guidance for as far as deposit is concerned for FY23?
No, we have, as far as deposits are concerned, we are already, we have activated our ground level machinery for shoring up the deposits. And I'm sure we have seen it in the past also. There is some lag in terms of when we prioritize certain things. And by the time we see the results, we have already seen it in the SME book and also in the Agri book. And we are quite hopeful that we will be in a position to see very good traction as far as the deposit mobilization is also concerned. We have increased our term deposit rates in the past, in the recent past, and we are, depending upon the asset liability mismatch, we are ensuring that we be, in fact, we should have a balanced approach towards the depositors' interest. And would like to mention that our cost of resources have gone up by just about 7 basis points by adopting this kind of an approach, which has actually helped us in ensuring that the efficient operation remains the cornerstone of the bank's balance sheet.
So no guidance you're giving in terms of the year-on-year growth?
Much of it will depend upon how the economy will have normally this quarter we'll also get to see some kind of liquidity flowing in. So that will also give us some opportunity to shore up the deposit, but no guidance as such.
Thank you so much, Abhijit. The next question is from Mayur Shetty of the Times of India.
Thank you, sir. I had two questions. One on deposits. The preceding quarter, the increase has been only some 23,000 crore, it looks like. And the budget, they have announced a lot of savings scheme with the rates of interest that are higher than what SBI is offering right now. So what will be the strategy going forward? Will you be able to increase the deposits in the fourth quarter? And the other clarification I had was on Adani again, because last year, a year back, there was a press release saying that the Navi Mumbai financial closure was achieved with SBI underwriting the 12,000 crore loan. So is that syndicated, or is that included in this total exposure?
Yeah, it is very much included in the total exposure, and it is also syndicated. In fact, the demand for loan was much higher than what the amount was available for syndication. So it is all complete. And your first question was relating to the deposit. What you have mentioned, that the government has announced with certain schemes. We are quite mindful and we are quite cognizant of the competitor strategy in this matter. And we ensure that we should be offering the deals which are equally competitive as well. But at the same time, we are ensuring that it should not really unduly impact our cost of resources.